Silver just did something. That has only happened a handful of times in the last 50 years, and almost no one is talking about it. While everyone was celebrating the rally, something else was quietly building underneath. Something far more dangerous. Central banks know it. Institutional traders know it. But the everyday investor, they are about to be blindsided. Because what looks like a simple correction might actually be the opening chapter of something much bigger. A reset, a reckoning, or perhaps the beginning of the greatest opportunity this generation will ever see. The question is not whether silver will recover. The question is, who will still be holding it when it does? Stay with us. Because by the end of this, you will understand exactly what is unfolding and what almost everyone else is missing. If you are someone who has lived long enough to remember what a dollar used to actually buy, if you've watched prices creep up year after year and wondered quietly where it's all heading, then you already understand something younger investors are only just beginning to learn. So before we go any further, I want to ask you for something small. If channels like this one matter to you, if this kind of honest, no-nonsense economic discussion is worth having, please take a moment to subscribe. Not for us, but so that the next time we sit down to break something like this apart, you don't miss it. And tell us, where in the world are you watching this from today? Drop your city, your country, down in the comments. We've got people from every corner of the globe in this community, and it means a great deal to know who we're really talking to. Now, let's get into it. For months, silver had been on a tear that few analysts expected. Investors who had patiently held their positions for years were finally being rewarded. Then, almost without warning, the rally stopped. The price did not just slow down, it reversed sharply, and within days, a significant portion of the recent gains had vanished. For many watching their portfolios, the shock was immediate and uncomfortable. This is the moment where most people make their biggest mistakes. They see red numbers on a screen and panic sets in. They start asking the wrong question. They ask, should I sell now before I lose more? Instead of asking the question that actually matters. What caused this, and does it change the bigger picture? To understand what is happening, it helps to step back and look at history. Silver has never moved in a straight line. Throughout its long history as a monetary metal, it has experienced violent price swings, both up and down. Sharp corrections after strong rallies are not unusual. In fact, they are almost a defining feature of how this market behaves. What separates a healthy pullback from a genuine collapse is not the size of the drop in a single week. It is the reason behind it, and what continues to happen in the weeks and months that follow. So what triggered this particular reversal? A combination of forces converged at once. Geopolitical tension flared up in a part of the world that rarely stays calm for long, and when conflict breaks out, financial markets react in ways that have little to do with long-term economic fundamentals. Capital moves quickly into perceived safety, then moves out just as quickly once the immediate fear subsides. This kind of shock does not last forever. Wars end, tensions ease, and markets recalibrate. Historically, the metals market has shown a consistent pattern. Sharp, fear-driven moves tend to fade once the underlying crisis passes, and prices begin searching for a new equilibrium based on actual supply and demand. At the same time, something less dramatic but more revealing was happening in the background. Many investors who had only recently entered the silver market, drawn in by months of rising prices, were not long-term holders. They were short-term traders, looking for a quick gain. When the price began to fall, this group exited fast, adding fuel to the decline. Their selling was not a reflection of silver's true value. It was simply a reflection of fear and impatience. Meanwhile, a very different group of people behaved in the opposite way. Long-term holders, the kind of investors who think in years rather than days, did not panic. Many of them viewed the drop not as a disaster, but as an opportunity. Some quietly increased their holdings during the decline, choosing to buy at lower prices rather than sell into fear. This divide between those who panic and those who stay calm is one of the oldest patterns in financial history, and it tends to separate successful long-term investors from everyone else. There's another detail worth paying close attention to. Even as prices fell, the physical market told a very different story than the paper market. Mining companies, refiners, and industrial buyers did not suddenly lose interest in silver. Demand from sectors that depend on the metal for real-world use did not disappear overnight just because a price chart turned red. This gap between what is happening on a trading screen and what is happening in the real economy is often where the most important signals are hiding. For business-minded individuals and serious investors, this moment offers a valuable lesson that goes far beyond silver itself. Markets are emotional in the short term and rational in the long term. A sudden drop does not automatically mean something is broken. Sometimes it simply means that weak participants have been shaken out, leaving the market in stronger hands than before. But this raises a deeper, more uncomfortable question. If this is simply a normal correction, why does it feel different this time? Why are seasoned analysts, the kind who rarely raise alarms, suddenly choosing their words with more caution than usual? That question cannot be answered by looking at the price chart alone. To understand what is truly happening, one must look beneath the surface at the mechanics driving this correction and the forces that may already be shaping what comes next. To understand why silver fell so fast, one must look past the headlines and into the machinery that actually drives short-term price movement. Most people imagine the silver market as a simple exchange between buyers who want the metal and sellers who own it. In reality, the price seen on any given day is shaped far more by paper contracts, leverage, and speculation than by anyone physically moving bars of metal from one vault to another. A large portion of daily silver trading happens through futures contracts. These allow traders to control a large amount of silver while putting up only a small fraction of its total value. This is called leverage, and it works well when prices move in the direction a trader expects. But leverage cuts both ways. When prices move against a leveraged position, losses grow far faster than they would for someone who simply owns the metal outright. This is where the real danger hides. As silver climbed in the months before the reversal, more and more speculative money poured in, much of it leveraged. Many of these traders were not buying silver because they believed in its long-term monetary role. They were chasing momentum, betting that the price would keep climbing simply because it had been climbing. This kind of buying creates a fragile foundation. It looks like strength on the surface, but it is built on borrowed conviction. When the geopolitical shock hit and prices began to slip, something predictable happened. Leveraged positions that had been profitable suddenly became dangerous. Brokers issued margin calls demanding that traders either add more money to their accounts or close their positions. Many chose to close, which meant selling. This selling pushed prices down further, which triggered more margin calls, which led to more selling. This chain reaction is sometimes called a cascade, and it can turn a modest pullback into a sharp, fast decline within a matter of days. This is an important distinction for anyone trying to make sense of the move. A large part of the drop had very little to do with silver's actual value or its long-term demand story. It had everything to do with forced selling by traders who no longer had a choice. Their decisions were made by margin requirements and risk systems, not by any genuine reassessment of silver's worth. At the same time, a strong dollar played its own role. During periods of geopolitical uncertainty, capital often rushes toward the US dollar and short-term government debt, viewed by many as a default safe haven, even when the underlying financial condition of that safe haven is far from perfect. As the dollar strengthened, commodities priced in dollars, including silver, became more expensive for buyers using other currencies. This added another layer of downward pressure, independent of anything happening in the physical silver market. It is worth asking who actually benefits when this kind of cascade occurs. Forced sellers rarely choose the timing or the price of their exit. They sell because they must, not because they want to. On the other side of these trades are typically larger, better capitalized participants who are not using leverage and who are not forced to react emotionally. These participants can simply wait, watch the panic unfold, and step in to buy at prices that the forced sellers never wanted to accept in the first place. This pattern is not unique to silver. It appears across nearly every market that allows significant leverage, from stocks to real estate to other commodities. Sharp, fast corrections are very often a story of overextended positions unwinding, rather than a story of fundamental collapse. Recognizing this difference is one of the most valuable skills a serious investor or business-minded individual can develop. None of this means that risk does not exist. Leverage-driven cascades can sometimes reveal real cracks that were hidden underneath speculative enthusiasm. The challenge is telling the difference between temporary mechanical selling and a genuine shift in the forces that determine silver's true value over time. To make that distinction, attention must shift away from daily price charts and toward something slower, deeper, and far less visible to the average trader watching a screen. Those forces, quietly building for years, may ultimately matter more than any single week of volatility. While traders argue over candlesticks and daily price swings, a slower and far more powerful story has been unfolding underneath. This story has nothing to do with margin calls or geopolitical headlines. It has to do with real physical demand for a metal that the modern economy increasingly cannot function without. Silver occupies a strange position among metals. Unlike gold, which is held almost entirely for monetary and investment purposes, silver lives a double life. It is both a store of value and an industrial workhorse. This dual identity is exactly what makes it so difficult to predict using the same logic applied to other assets, and exactly why short-term price drops can mislead even experienced observers. Consider where silver actually gets used once it leaves the ground. Solar panel manufacturing has become one of the largest and fastest growing consumers of silver on the planet. Each new wave of solar installation, driven by national energy policies and falling technology costs, requires real, physical silver that must be mined, refined, and delivered. This demand does not pause because a futures contract had a rough week. It continues, regardless of what happens on a trading screen. Electronics tell a similar story. Silver's unmatched electrical conductivity makes it essential in countless devices, circuit boards, and components that touch daily life in ways most people never consider. As global electronics production expands, so does the quiet, steady appetite for silver that has nothing to do with speculation. Then there is the supply side of the equation, which receives far less attention than it deserves. Unlike gold, the majority of silver does not come from dedicated silver mines. Much of it arrives as a byproduct of mining other metals, such as copper, lead, and zinc. This means silver supply does not simply increase just because prices rise. Mining companies cannot easily flip a switch and produce more silver on demand. Discovering and developing new deposits takes years, sometimes decades, and requires significant capital investment during a period when many companies have been reluctant to spend heavily on exploration. This creates a structural gap between how quickly demand can grow and how slowly supply can respond. When industrial demand accelerates, as it has in recent years, the market does not have a simple mechanism for quickly producing more metal to meet it. This imbalance does not show up clearly in a single day's price action, but it shapes the landscape that price action eventually has to confront. Beyond industry, there remains silver's older identity as a monetary asset, one that has not disappeared, even in a digital age. Central banks around the world have been reassessing how much trust they place in traditional reserve currencies and government debt. Some have quietly shifted toward accumulating precious metals, viewing them as a hedge against currency devaluation and shifting geopolitical alliances. While much of this attention has focused on gold, the broader sentiment, distrust toward paper promises, and renewed interest in tangible assets inevitably touches silver as well. This is the heart of what separates structural forces from short-term noise. A leveraged trader unwinding a position because of a margin call operates on a timeline of days. A solar manufacturer planning production for the next decade operates on a timeline of years. A central bank adjusting its reserve strategy operates on a timeline that can span an entire generation. These different clocks rarely move in sync, and that mismatch is precisely why a sharp weekly decline can coexist with a fundamentally strong long-term demand picture. None of this guarantees that prices must rise immediately, or that further short-term pain is impossible. Markets can remain disconnected from underlying fundamentals for uncomfortably long periods. But for anyone thinking in years rather than days, the structural story beneath the surface tells a very different narrative than the panic visible on a daily chart. One defined not by fear, but by a slow, steady tightening between what the world needs and what the earth is willing to give up. By this point, two very different stories have emerged. On the surface, a sharp correction driven by leverage, fear, and forced selling. Beneath the surface, a slower and more structural story of rising industrial demand colliding with a supply chain that cannot easily expand. The question that remains is simple to ask, but far harder to answer. How does a disciplined investor actually act when these two stories are unfolding at the same time? The first instinct for most people during a sharp decline is to do something, anything, to make the discomfort stop. This usually means selling. It feels productive in the moment. It feels like regaining control. But history shows again and again that this instinct is often exactly backward. The investors who tend to build real lasting wealth are rarely the ones reacting fastest to short-term fear. They are the ones who have already decided, long before the panic arrives, what role an asset plays in their broader strategy. This is the real difference between speculation and investing. A speculator watches the price and reacts to it. An investor understands the underlying asset and uses price movement, even painful price movement, as information rather than instruction. When a structural demand story remains intact, a price decline driven mainly by leverage selling does not change the underlying thesis. If anything, it offers a more attractive entry point for anyone who had not yet built their position. This is precisely how disciplined capital tends to behave during moments like this. Rather than chasing the asset during euphoric highs, it waits patiently. Then, when fear forces weaker participants to sell at a discount, it steps in calmly and absorbs that selling. This is not a dramatic or emotional process. It often looks almost boring from the outside, a series of quiet, unremarkable purchases made while headlines scream about chaos and collapse. Diversification plays an important role here as well. Smart positioning does not mean placing all available capital into a single asset and hoping for the best. It means understanding silver's place within a broader portfolio, alongside other forms of value, and sizing that position according to one's own risk tolerance and time horizon. This approach allows an investor to remain calm during volatility because no single price swing threatens their overall financial stability. There is also a discipline of patience that deserves attention. Structural shifts in supply and demand do not resolve themselves in days or weeks. They play out over years, sometimes longer. An investor who expects a single quarter to validate or destroy a long-term thesis is setting themselves up for unnecessary stress and poor decision-making. The forces discussed earlier, industrial demand, constrained supply, and shifting monetary trust, do not care about anyone's short-term timeline. At the same time, discipline does not mean blind faith. A serious investor continues to monitor the underlying fundamentals, watching whether industrial demand actually continues to grow, whether supply constraints persist, and whether the broader monetary backdrop continues to shift in ways that support the original thesis. Conviction without ongoing observation is just as dangerous as panic without analysis. What ultimately separates those who thrive through periods like this from those who are shaken out is not access to secret information or perfect timing. It is temperament. It is the ability to look at a falling price, understand why it is falling, and make a calm decision based on a framework built long before the volatility began. The final question, then, is not whether silver will recover. Based on everything explored so far, that question may already have a clearer answer than it appeared at first. The real question is who will still be holding their position with conviction and clarity when it does.